So the final topic that we're going to talk about is the importance of understanding order flow relative to the price action and the price studies that we can apply to various charts. So I'm not promoting or debunking any type of strategy. How you decide to execute your trades is really entirely down to you. Whether you want to use the technical indicators that are offered on platforms, whether you want to look at price action study, whether you want to just go on breakouts and um, structure breaks, things like that. It's really down to the individual. It's your account. It's up to you how you decide to execute those trades. But what we need to understand is, now that I've shown you a clear representation of the order book, inside the order book, and how price can be driven with large orders, it's really important that we now understand that any study that we can apply to a chart, so whether it be uh, one of these like a technical indicator, such as this, just a random one that I've picked up, or whether it be a price action study, such as head and shoulders or equal highs, equal lows, whether it's breaking market structures and institutional order flow, whatever it may be, these markets are susceptible to large orders anyway. So if we take price action studies into account, just because it's easier to read on the charts, we just try and find a very basic um, price action study. So here we have a couple here lined up. We have the equal highs here, and we also have the equal lows here. Now, this the theory of equal highs and equal lows could be foolproof. It could be that the be all end all. It may be that equal highs will always hold price, and equal lows will always hold bids. For argument's sake, let's just assume that that is the scenario. So that if we see double bottoms, we're guaranteed to rally off of them. But me as an institutional seller hasn't seen the equal lows on the price. I could just sell 1,000 contracts or 200 contracts, however many contracts it may be, and we will trade below these equal lows, disregarding anyone that's buying off of the equal lows. And this is the same scenario for any strategy, any holy grail, anyone that preaches a holy grail to execute in their trades. All we can be is accurate. We can't be uh, the holy grail. We can't be 100% foolproof or 100% accurate with our trades. We can be close to it using the various um, tools and whether it be indicators or price action studies or whatever it may be. Even using the order flow techniques that as a market maker is what I sort of predominantly delivered to the markets. Any such thing like that will work until a larger trader or a large trader with large uh, order sizes pushes through certain price points, and we see that constantly all the time. Like now, for example, we can just take a scenario where we're trading around equal lows. That may be fine. The price may be holding. We may look to be a buy here. But if I'm deciding to just suddenly sell the market, then I'm going to do something like this. So anyone that has an order here, if trading off of an equal low is what we so desire to be the profitable scenario, how far do we need to put our stop? If we have a 10 pip stop, if we have 20 pips, or if we have 30 pips, we could continue to drive price all the way down past your 30 pip stop and then continue to go higher. It is all relevant to the orders coming in, and unfortunately, we will never know what orders are coming in, nor will anyone know what orders are coming in, unless obviously the person has told us, uh, whoever the large trader is, has said, this is my order and I'm going to sell it at this price and the market's going to go lower. We won't ever know that. We can make good judgment calls on price points based on what price has already done, or based on the existing order flow in the market and the defensive positions. But in terms of being 100% and finding the Holy Grail, we won't know that, because there will always be somebody that will want to counteract what our thoughts are, not intentionally, but because of the order that they have to fill, and then subsequently drive price in the opposite direction. And it may be that we see something like this, where we see price trade all the way down past a specific price point that we're interested in, and then just trades all the way back up. So we become stopped out, we take a loss, we take a hit, and then we continue higher. So there is always that to consider, regardless of the strategy that people use and people preach. Um, the markets are susceptible, as we've discussed throughout the whole of uh, the videos here. They are very susceptible to being bullied, especially the very illiquid markets like this. Not so much, not so much in the more more thicker markets, such as the T notes, and the close end, the short end of the bond market.